Hey, welcome FreightWaves fans and friends, ladies and gentlemen. We have got a special FreightWaves Now for you, coming to you live right now. We have the CEO of FreightWaves himself, Craig Fuller, the visionary of Freight Futures, here to talk about, well, Freight Futures a little bit. Because why? Because we are on the road today. We are in Dallas. We are streaming live to you. So tune in on our site if you can't be there live. So Craig, welcome, and we are you are going to tell us a little bit about, well, why futures right now? What is futures?
Yeah, so futures are basically a product that's used to hedge or speculate on the direction of price. And specifically, trucking freight futures is a partnership between DAT, the benchmark provider of pricing in the freight market, Notable Exchange, which is a regulated financial exchange, and FreightWaves. And so the three parties have come together to create a futures contract that will be tradable and allow companies to de-risk or hedge their exposure to the volatility of trucking spot rates.
That is awesome. Thanks for that brief summary of what the idea is. One of the things is, it's a gigantic industry, trucking is, and a lot of people are like, wow, this was such a good idea. Why hadn't I thought of it? What makes it, why now? What makes this such an exciting opportunity now?
Yeah, so timing is everything in life, and particularly in business and in startups. Venture startups succeed because they are timed appropriately. And I think this is the reason that futures will take off now. Had it had been done a few years ago, it would likely have not been as successful. And I think the real fundamental reason that trucking freight futures really makes sense right now is that we have access to data. With the ubiquity of smartphones, we're able to get access to where capacity's at. We've gone from on-premise computing to cloud. Data is being transferred between companies, between trucking companies, providing data services to people like DAT that assemble an index. And in order to create a financially settled futures contract, that's the important piece here.
Right.
There are no trucks that show up. And this question gets asked a lot. What happens if the truck drops off? A truck will never, ever bump the dock. If you happen to trade a future and you happen to expect that truck to show up, it's going to service fill 100% of the time because there is no physical truck, and that's very important. These are financially settled contracts, which means participants in the market are betting on the up or downward movement of the market. Now, it's very important to understand what that means. It means that if you are in the market today and you are a shipper, then you are inclined or you desire for rates to go down. If you're a trucking company and you own trucks, you want rates to go up. And so we think about that. That is your natural exposure in the physical market. In the futures market, if you're hedging, you're actually going to trade opposite of your exposure. And that's really important. And so this in itself does not actually change the outcome of the physical market in the actual physical outcome. So one of the things that happens is people say, well, this is going to destroy the truckers, or this is going to destroy the shippers, the brokers, whatever. It doesn't actually do that. It's a risk management product that's used to help identify and provide a way for companies to understand where the market is headed. And frankly, if you look at the advent of futures contracts and futures markets, is they actually mitigate volatility. They lower the volatility because price is more certain, because people can predict better about where the market's headed.
Well, that is awesome. That's an interesting thought, thinking ahead about how maybe there's a lot of players, a lot of ways to be volatile in the market right now, and that's the very reason for freight futures. That may actually minimize some of the risk. That's interesting. Well, one of the ways that you're saying that is the perfect storm is because of technology and access to it. We have a very important index that you're going to give us a little more intel on interpreting the DAT freight rate index.
Yeah, so the DAT, so we went 2.5 years ago when we decided that we wanted to launch trucking futures. We went out and did a lot of research on spot indexes and index providers. And we said, we need the most reliable benchmark provider in the market that is broadly recognized, because people have to recognize it and treat it as reliable. It has to have a methodology that is sound and not exposed to manipulation, and it has to have really strong metrics to it that track the market. And as we did this study, we found that DAT's rate index was the most reliable. What we did find in that as well is that there were opportunities for, if you're going to create a financially settled futures contract, you actually don't look at the market identical to the way a physical broker would look at it, or a physical carrier. And this is a very important differentiation.
Okay.
In the way that the trend line, so people look at trend lines, which we all recognize goes out every week. It's a great product to understand what's happening. The challenge of using trend lines is that it's a national average, and the way it's built is to show general trends in the market. It's not really great for trading futures because of the fact that the way that particular index is weighted is different than what happens in the physical market. So as we rolled out and looked at futures methodology, working alongside DAT for this, we realized we needed a different perspective on how to look at the data. We needed to have a very clean data set that didn't have a lot of noise in it, and it was weighted based on specific lanes. And so we actually chose lanes, and let me show you over here. If we walk over here, you can see the lanes that we chose. And the reason we chose these lanes is they're highly correlated to the broader parts of the market. They're highly correlated to activity. By looking at these different individual lane pairs, you can predict the price movement in 85% of the market without having to trade every single lane. And so the lanes that the rates, the cities, if you look at it, Philadelphia, Chicago, Atlanta, we have what we call the East Coast corridor. That's related to the East Coast rate. So you actually are trading specific lane pairs. You have the West Coast corridor right here, which is a West Coast index. And it's LA, Seattle, Seattle, LA, LA, Dallas, Dallas, LA. And so it's important to know those load pairs. And then what happens is the balance between those is put into an index, and the balance between these are put into an index equally weighted, which is why the DAT freight rate index, which is on this screen behind you,
want to come back over here?
Is actually different than trend lines. And this is really important because of the way that this particular index is weighted versus the national trend lines numbers.
Okay, and here we have a 5-year, we have it on the 5-year. Rates are pretty low right now. Shippers paradise.
Yeah, because on those core lanes, you have to keep in mind when you're looking at the market and you have weighted on head haul, back haul. If your index itself is heavily weighted toward head haul, you're going to have a challenge of having the rates bigger than what they are. Okay. If it's heavily weighted toward backhaul, then it's going to be more weighted toward the backhaul part of the market. And this is a really important way to think of it, is that this particular methodology, which is really important to understand methodology, is using highly, highly representative lanes of the overall market, equally weighted on head haul and backhaul. So it's more reflective of the conditions in the market, which is a big important element when you're looking at this particular index versus what you're used to see on trend lines. Okay,
is this this particular one? Is this stripped down for us? Is this?
This is the actual index that will be. This is the national basket.
Okay.
Which is a basket of the lane pairs aggregated. And there is going to be seasonal representation related to spot. And because these are highly liquid lanes that have consistent traffic between the lane pairs, it's more representative of the market than using a national index that's weighted differently. And I think that's a really important thing to understand what you're really looking at. So when you look at the larger numbers and you say that the average rate's $1.91, drivers are like, I don't see $1.91. It's not showing. It's because when you weight it across the whole country, you actually inflate the numbers. Whereas you clean it up to particular lane pairs that are highly, highly liquid and highly, highly trafficked, it's going to be more reflective of the market.
Thank you for that. That actually explains a little bit more when our chief data nerd Daniel Pickett was on yesterday, and he was talking about it in some mathematical terms. And and now this is bringing it. Well, it's still a macro view, but bringing it down, making it a little bit more clear for us. So we have one more question for you about how that works.
Yeah, so a couple things to keep in mind is about futures is that there's a lot of uncertainty in the market, and I think this is an interesting time. You asked about timing. Why now? So we very well could have launched futures contracts last year. The problem is everybody last year knew that rates were going to go up. There was no secret to the direction of rates. Now you don't know if they're going to go way up or how far they're going to go up, but everybody agreed they're going to go up. If we had launched them in a declining market, I think everyone would have agreed that rates were going down. This is a really interesting time in trucking because when you listen to the larger trucking companies and the public earnings, they're all pretty bullish about 2019. When you look at the way shippers are looking at it, or freight brokers, or even some of our own data, it looks a little less promising a little less bullish in terms of trucking. And that is actually the perfect time because no one knows what direction rates are going to go in. And so if we end up in a recessionary environment at the later part of the year, rates are likely to fall. If we have a new trade policy and we end up where economic activity comes back and we start to see really strong economic indicators, that could indicate that the freight market will strengthen and rates will go up at a level that may be similar to last year. We just don't know. And because we don't know, and I don't care who you talk to, nobody knows the state of the economy going in 6 months out. And without having a futures market or having a forward index, it's very hard to know the direction, and that's the perfect part of futures.
That is amazing. Thank you for that commentary, taking some time out of your busy schedule, Craig, to tell us a little bit more about futures and giving us, a reason why now. And actually, that is the very question that Michael Crosby, the Wizard of Croz, is going to be answering momentarily here. We're saying okay, it's a shipper's paradise, but what are you doing here? You think you're going to be living in Jimmy Buffett land here? It's going to be a paradise here. You're going to be sucking on your margarita and keeping rates real low, we want it lower if you want it bearish sort of, you want it low if you're a shipper. But what do you think? It's like an ERA, it's like a golf score. You want to keep that down, but really, is it really going to remain low? Well, you got to hedge your risk and manage it. And finally, we are going to be breaking to you right now what is happening right now with the weather. Is California falling into the sea yet? Nick Austin, tell us what's happening.
No, but part of it's drowning, that's for sure.
Okay.
Bad news out in California. First, we're going to talk about snow, though, because that's way worse for drivers. The Sierras. We talk about the Sierras all the time in the winter. That's this area right in here where you see that snow, all that heavy snow. Eastern California, near the Nevada state line. From over the next couple of days, right before the weekend hits, 5 feet or more of additional snowfall in the highest elevations up there. Now that's mostly where the ski resorts and places like that are, but even along I-80 where a lot of truckers try to get loads, say out of Utah or Colorado into Northern California, some parts of I-80 will likely be closed if they're going to try and go through the Sierras, which they often do. It's a pretty popular route for drivers. So it's happened on and off over the past several days during these snowstorms where parts of I-80 are closed. Other routes through go over mountain passes are closed. And you get turned around or you just get delayed for a long time because traffic's just stuck there.
Yeah, okay.
Snow and ice. The foothills, some of the lower elevations of the Sierras will get snow as well. In the valley along I-5, if you're trying to get stuff between Seattle and down to LA, that's going to be tough too along I-5. Some parts of I-5 north of Redding are actually going to see snowfall. And there's a lot of rain, flooding, possible road closures because of mudslides and debris flows and stuff all on the west coast of California particularly. There's going to be a lot more heavy rain off and on from San Francisco all the way down to San Diego. They've already had wind damage as well as reports of flooding in a lot of areas.
Is there a good, this is a lot of bad news, which I know
yes.
is what bringing the weather is, but is there any good news in that? I mean, does California desperately need the precipitation, even though I know they don't need it in the form of a storm, but...
Well, some parts of California are still in drought.
Okay.
But in other areas of California, the drought is gone, where there used to be problems.
Right.
So that's one positive aspect of the rain and the snow. It's
looking for that silver
It's just
lining.
the rain is coming too much at one time.
Yes,
that's the problem.
yes.
That's what you don't want.
Speaking of volatility.
And that heavy rain is going to be moving through Phoenix and Las Vegas later today.
Okay.
Wow. And then more heavy snow in parts of the Rockies later today and tonight too. But they're used to that out there. The good news is that across the rest of the country today and tonight, the weather's going to be pretty quiet. So that's good. That's the good news.
That is the good news. See, he doesn't always just bring you the bad news as the weatherman. He is bringing it to you. He's just calling it like it is. And we are coming to you calling it like it is and whatever the indexes may be on FreightWaves Now each and every business day. So stay tuned. We will be here with you tomorrow on Friday, looking ahead at the rest of the, not only what's happening on Friday, but a look ahead at the weekend. So thanks for tuning in. Check out our road show on the Freight Futures. Check us out at freightwaves.com and on Twitter, and we will see you soon. And don't worry, be happy.